So let's talk about the stock markets. When you buy a stock, you have bought part ownership in somebody's business. So FanMill Ghana Limited is listed on the stock exchange. When you go and you buy shares in FanMill, you would have become a shareholder of FanMill, which means you have a say in the way that the business is run and a share of the profits that the business will generate. Typically, how you buy a company is buy a company share is during an IPO or when it is listed on the stock exchange. So if a company is looking to raise money, it does what we call an initial public offer, where it invites individuals to buy shares in that company. Okay, so you can buy shares when the company does an initial public offer, or you can buy shares when the company is listed on the stock exchange. And there are two things you get when you buy shares: dividends and capital gain. So if you buy shares and a company makes profits and distributes the profits to its shareholders, what you get is called dividend, which is your share of the profits of a company that you have invested in. Capital gain is the increase in share price of a company that you have invested in. So let's look at a case study. So here's a handsome young gentleman called Yao. Okay, Yao likes to think, dream. He has some money and he has a good idea. Okay, why don't I start investing in a cocoa processing plant? Now, I've read that the country is looking to encourage more cocoa to be processed in Ghana. And then we heard the president saying that we have to increase the amount of cocoa processed in Ghana from 30% to 50%. So my good friend Yao, who has some money, about 3 million cedis, says, I want to set up a cocoa processing plant in Ghana in line with the objectives of the government. And there are several incentives that have been set up for me. So let me establish a cocoa processing plant, put in my 3 million, and find additional money to invest in the business so that I can make a good return. So he does his analysis and he realizes that he needs 15 million cedis to set up a world-class cocoa processing plant to process cocoa and sell in the international markets. And many of you know that when you process cocoa and you are selling, the value. So our good friend, who's a cool dude, thinks, let me invest in a cocoa processing plant so I can make more money. I'm looking to grow my 3 million cedis. I have 3 million, the capital required is 15 million. So what does Yao do? There are two ways in which Yao can raise money. Either Yao goes to look for a loan, okay? He takes debt, or he goes to look for equity, which means he will look for people who will join him in investing in the cocoa processing plant. So as a company, you raise money in two ways, either debt or equity. So debt is where you go and borrow from a bank, you take a loan from a bank, or you issue a bond so people can buy, but that is debt. And then you pay interest on that debt. For equity, you invite other people who have money that want to invest for a return to put money into your business. And so they become shareholders in that business. So Yao has two options, either to take debt or to take equity. So to start with, Yao goes to a bank and the bank says, okay, we'll give you 5 million out of the 15 million you are looking for. Remember, Yao has 3 million. So he takes 5 million from a bank. So there's still a shortfall. He only has 8 million. He still needs to find the rest of the money from elsewhere. So Yao will then go around and talk to people that he knows that I have an idea to build a cocoa processing plant. I need 15 million. I have 3 million and the bank has given me 5 million. I need to raise the rest of the money from you. And he will tell you about cocoa processing and the prospects of making money in that sector. So Yao will start talking to people to look for equity. So Yao will find the first person, Kojo. He convinces Kojo, who is known from university, and Kojo gives him 1 million. There's still some way to go. So Kojo becomes a shareholder in Yao's cocoa processing plant. He has invested in the plant, he becomes a shareholder. So together they keep going out to look for additional money. They find a couple who have money and they give them 2 million. So this couple also becomes they become shareholders in the cocoa processing plant. Okay. They need more, so they go out and then they find another person, Kindi, who gives them an additional 2 million. Then they go and find another family of people who have come together and contributed called Eminshe family. So they give them an additional 2 million. So at the end of the process, they have raised the money. Between debt and equity, Yao has found the money, 15 million in all, to fund his cocoa processing plant. So he's raised 7 million from shareholders, 5 million from a bank, and 3 million of his own money to make up the 15 million, which he puts in the cocoa processing plant. So there are different shareholders of this plant. 4 new shareholders in addition to Yao. So there are 5 shareholders of the company, and then there's one bank who has invested debt in the business. The 15 million then goes into the cocoa processing plant. So we start business. At the end of the first year, we've made sales of 12 million. Cost of sales is 7 million. Our company makes profits of 5 million. We pay interest on the bank loan of 500,000. So we have earnings before interest and tax of 4.5 million. We pay tax to the government of 1.1 million. Then we have profit after tax of 3.3 million. So fantastic. That's good news. In the first year of our cocoa processing company, we've made profit of 3 million. What will we be doing as a shareholder? Kojo T, you are the shareholder. Would you want to take the profits, or would you want the company to put all the money back into the business so they can generate new returns? It's always a conundrum, but managers have to decide. So maybe the company will decide that let's share 1 million, okay, of the profits we made to our shareholders. Now the 1 million that will be shared, it will be shared according to the amount of money that the shareholders put in the business. So Minshe family, Mr. and Mrs. Sika will make more money than Kojo T because they put in 2 million each and Kojo T put in 1 million, if you remember our previous slide. So in sharing the 1 million, the 3 shareholders who put in 2 million will make double what Kojo T made. So that will be the dividend that is shared amongst the shareholders from the profits that a company has made. Now, all of us will be praying that as the years go by, our cocoa processing will be more, we'll make more in sales, and we can generate more profits so that the dividends that we get from the company will increase. Now, while the dividend is increasing, our company value is also increasing. Because if you put in 2 million today, and the company has made 3.3 million profits, and you want to sell all your shares, you will definitely not accept 2 million back. You'll be asking for 2.5 or 3 million, which would mean that you have made a capital gain. Assuming somebody buys the shares from you for 3 million cedis, you would have made a capital gain of 1 million. So you would have made a capital gain in addition to the share of the profits that you have taken from the company. So you've got capital gain and dividend as the return that you make from investing in that company. Now, if you want to sell your shares, Kojo T wants to sell the shares. How will he find somebody to buy the shares from him? That is the first difficulty. The law will say if you're a private company, you should make an offer to the other shareholders. What if the other shareholders don't have money? What do? That is why the stock exchange comes in. So if this company decides to put its shares on the stock exchange, it means that every day people are looking at the company, and if you want to sell, you have the opportunity to put your shares on the stock exchange, which is an open market, and people who are interested can buy on a daily basis from you. Okay. Because there are difficulties in finding somebody to buy your shares if it is a private company. So that is where the beauty of the stock exchange comes in, where we match buyers and sellers together. So that if you are an investor and you are looking to buy stocks, you go to the stock exchange, you will find a company where its shareholders may be looking to exit, and then you can buy from that person. So that is where the stock exchange brings buyers and sellers together, especially investors that are looking to make capital gains and dividends from investing in stocks. Okay. So after some years, our business decides to expand, which is our cocoa processing company, or some shareholders want to sell. So we take our money and we go public we put our company on the stock exchange. Okay. We do this through brokers and other agents who advise us as shareholders of our cocoa processing company to do an initial public offering where we will sell our shares for the first time to the public. People will buy, and then after that, our company gets listed on the stock exchange where people can now start buying and selling shares that they have bought from our company.